Hi, everyone. We're going to get started. Good morning, good afternoon, or good evening, depending on when or where you watch this. Welcome to the Yale School of International Affairs at the George Washington University here in Washington, D.C. My name is Remi Jedwab. I'm the Director of the Institute for International Economic Policy here at the Yale School. I'm also an Associate Professor of Economics and International Affairs. I'm delighted to welcome you to a great lineup of speakers and discussants to learn more about the theme of the event. Today it's governing finance and climate change. First, I want to thank our staff at IIEP. I also want to thank our executive circle of supporters who have made this event possible. I also want to thank Sunil for organizing the conference, and I want to thank the CEP, the Council on Economic Policies, and the director, Alexander Barkawi, for organizing this with us. For those who don't know us, IIEP is an interdisciplinary research center. We focus on economic globalization broadly defined. We have different initiatives related to poverty studies, development economics, international trade, international finance, climate change, and international economic policy more broadly. We have had quite a focus on China's economies and India's economies over the past 2 years. We have organized more than 175 events in the past 2 or 3 years. This is one of the last events of the year, actually, for the academic semester, but that's actually one of the most important. Our central banks can help with climate change. And so you can find our old events on our YouTube channel, which is at IEPGW. And now I'm going to introduce Sunil, who is our distinguished visiting scholar. He had a long career at the IMF before joining GW, and was also a member of the econ department at UCLA. So Sunil, the floor is yours. Thank you.
Good morning, everybody. Let me add my welcome to Remi Jedwab. It's always nice organizing a conference in this room. It's probably a room with one of the best views of Washington, D.C. And it's a pleasure to be here with all of you. What I'm going to do is try in my brief remarks to set the stage for the panel discussions. Humanity and nature are intimately connected. In fact, our human systems are derivative and depend on the health of our natural endowments and environmental cycles. For example, the carbon cycle, the nitrogen cycle, the hydrological cycle, and so on. Today's overwhelming scientific consensus is that human activity, especially in the last few decades, has disrupted the biosphere and the environmental cycles on which we depend, and our activities will continue to do so for some time to come. The IMF and the World Bank forecasts released in the last few days have painted an unsettling picture of global prospects for growth. It is pertinent today to speak of fiscal and financial dominance of policies, meaning that government budgets are stretched, debt loads are overly burdensome, and fiscal space to bear additional expenditures is compromised. That the state of the financial system is weak and existing fragilities constrain the conduct of monetary, financial, and other policies. As we are seeing the rapid rise in global interest rates, to fight inflation has created stress in the financial system, led to the failure of mid-sized US banks and a large internationally active Swiss bank, revealing weaknesses still present in the system and threatening to unleash global contagion. This tells us that the status quo is shaky and unsustainable. Even more ominous is the prospect that in the current state we are entering an era that I call an era of climate dominance. Climate dominance will encompass physical, fiscal, and financial dominance. Climate dominance will impose a physical reality that forces us to contend with the consequences of depleting natural capital and disrupting the environment. It will not only make life more difficult and less conducive to human systems as currently conceived, but also make urgent demands on our fiscal and financial resources to deal with the disruptions and disasters caused by a more volatile environment. And if the scientists are right, we ain't seen nothing yet. Climate change will first add additional uncertainty to the conduct of all policies. Second, have us contend with more intense and frequent climate events, fires, hurricanes, sea level rise, biodiversity loss, disease, and pandemics, leading to more recurrent and larger real supply side and demand side disturbances. And thirdly, create transition hazards as we change the structure of our production, consumption, transport, and energy systems and move forward with the ongoing digital transformation. These risks will have consequences for price stability, relative prices of goods and services, asset valuations, the distribution of income and wealth, and financial stability, not to mention societal cohesion. A functioning monetary and financial system is an important public good and will be needed for any appropriate and sustained societal response to our changing circumstances. Decision-making will take place under deep uncertainty. Measuring, assessing, and translating climate risks into financial risks will be challenging. Climate change generates multidimensional and difficult to measure risks to human and natural systems. Many risk factors emerge from qualitative expert assessment. Aggregate risk measures, while useful, can sometimes hide information that may be useful for decision makers. For example, they may obscure inequities and who gets affected. Single measures also lead to what is called uncertainty absorption. Equal or constant weights may not always be justified. Risks may be highly nonlinear and connected. Multiple attributes may be useful in ascertaining tail risks of cascading and nonlinear effects. The COVID pandemic experience provides a recent example. Recent research suggests that large, novel pandemics are more likely than we thought, and their effects depend on the timing and dynamics of policy and social response. Similarly, depending on the pace of transition to a nature-friendly economy, multiple climate and transition risks could be elevated, sometimes considerably so, for extended periods of time. It was said of the 2008 global financial crisis that it was not only a failure of policy, but it was also a failure of imagination. To deal with the climate crisis, we will need to be far more imaginative, have a stronger collective resolve, and develop a desire and capability to experiment with technological, financial, commercial, organizational, and social options. Governance in the conditions of the Anthropocene is the issue of our times and a subject of intense and, at times, emotional debate. Today's focus will be on a specific subset of governance issues that are central to the larger debate. Finance is the lifeblood of market-based societies and the international monetary and financial order, or as some would call it, non-order. How we govern it is important. The seminar will focus on the role central banks and financial overseers must play in addressing climate-related risks to the financial system. Let me end by making two remarks. Tim Lane, Mark Livonian, and I are working on a paper on today's topic, and let me thank you in advance for your input into our joint endeavor. Let me also say that at the outset, we have circulated the detailed bios of all our distinguished speakers, and in the interest of time, we will introduce them briefly before each session. With that, let me bring to the podium Alex Barkawi, who is the Director of the Council of Economic Policies, and we've been collaborating on such events for some time. Besides before directing CEP, he was the managing director of the sustainability in Dow Jones indices. With that, Alex, the floor is yours.
Wonderful. Good morning, everybody. Thank you very much, Professor Jedwab, for your warm welcome. Thank you, Sunil, for so compellingly setting the stage, and most importantly, thank you all for being here. As Sunil highlighted, paying attention to the governance of finance is important for many reasons. And I think its role in addressing the risks from climate change and the transition to a low-carbon economy is definitely one of them. And thus, I'm really delighted that we have this morning here jointly to discuss where central banks stand, where financial supervisors stand in accounting for climate-related financial risks, and also, just as importantly, to discuss pathways forward that we think should be considered. This first panel is focused on monetary policy, and thus, among many other questions, on what central banks already do to assess the impact of climate risks and the transition on monetary policy and its objectives, what they've already done to account for these impacts in their operations, and what we think they should do moving forward. And to do that, we are really grateful to have three panelists with us who have engaged on these topics for a very long time. Sarah Bloom Raskin, a very warm welcome. The distinguished professor of the practice of law at Duke University, and among many other previous roles, the former Deputy Secretary of the US Treasury and former member of the Federal Reserve Board. A very warm welcome to you, James Talbot, Director of the International Department at the Bank of England, and crucially for this discussion here, also the chair of the monetary policy workstream of the NGFS. For those of you who are not familiar with that acronym, that's the Central Banks and Supervisors Network for Greening the Financial System, a network of now just over 120 central banks and financial supervisors engaged on the topic. And finally, if things have worked out, yes, indeed, we have Timothy Lane. Tim, a very warm welcome to you too. Tim is the former deputy director of the Bank of Canada. Prior to that role, has been with the IMF for 20 years, and unfortunately slipped. And had a few fractures from that, therefore cannot travel. Tim, we miss having you here in person, but are delighted to have you online, and obviously wish you a very speedy recovery. And with that, let's jump right into the discussion. We'll have some opening remarks from all panelists, then I'll use the privilege of chairing to ask some follow-up questions, and then we'll open up very soon to all of us. And with that, Sarah, the floor is yours.
Fantastic. You're fine?
He is fine.
Sure. Okay. Well, thank you, Alex, for that, and definitely looking forward to the discussion today. Both really to be with James Talbot and, of course, with Tim Lane. So that said, I should also say it's really good to be in an audience that has been on the leading edge of people who are really taking into account monetary policy and its integration with climate-related financial risk. The fact that we're having these discussions at all, I think, is really a testament to the people in this room who have done so much to, well, first of all, to sort of break down the barriers between monetary policy and the public communication and understanding of how monetary policy works, but also, and most recently, understanding the different silos within central banks that really go beyond monetary policy. So monetary policy, financial supervision and regulation of banks, financial stability mandates, wholesale funding markets, and of course, distributional consequences. These are all aspects of central banking. And
Okay, welcome back, everybody. Where were we? Probably just on that point on uncertainty, or fragility, or
urgency. Yeah.
In any case, welcome back, everybody. Sarah, the floor is yours.
Okay, as I was saying, well, first of all, I do want to thank everybody. This is going to be a very good discussion. We've got some really important linkage questions that we're going to explore. Questions also that are going to elucidate what exactly the transmission mechanisms look like between climate-related financial risk and monetary policy, okay? So I'm very much looking forward to this, and also wanted to thank people in the audience for the work you've been doing to illuminate these connections. So what we're talking about here when we talk about the conduct of monetary policy, particularly as it is done by central banks that have many functions, is really no better illuminated than in this recent bank crisis. Okay, so if there's any lesson that we take from this last set of bank failures, it's really that the functioning of central banks in the realm of monetary policy is going to be suboptimal when you do not integrate supervision, regulation, and other understandings of risk, okay? And what is supervision and regulation? It really is the identification, monitoring, and mitigation of risk. All right. Now, you might think, well, what does the failure of SVB or the Swiss banks or this bank in New York called Signature Bank, why should that even be relevant to what we're discussing today? And I think we've seen a couple of things that came from those episodes. So from that weekend in March, where the Treasury Department, with the collaboration of the Federal Reserve, declared that we were in the midst of a systemic risk. There was a systemic risk designation that was made as deposits were fleeing Silicon Valley Bank at an unprecedented speed. Interestingly enough, neither SVB nor Signature Bank were what are called SIFIs. They were not these large mega banks. They were banks of a regional and even community bank size, and yet they triggered a systemic designation. Okay, and then other things followed. Once there was the systemic designation, pursuant to law, different facilities could be put in place that attempted to backstop the run and to keep the contagion from moving further. And what was at stake really here was a failure of supervision, a failure of interest rate risk management, which is a particular aspect of bank supervision, having to do with what banks are supposed to do when they are faced with a changing interest rate environment. And of course, there was a changing interest rate environment because the Fed was conducting a fight against inflation, which entailed successive increases in the federal funds rate, okay? This, of course, had been put in place, much earlier than the weekend of, March 10th and 11th. The Fed had signaled, the Fed had been on a path for increasing the Fed funds rate for about a year, right? And had signaled before. Everybody kind of knew that the interest rates were changing. And yet, what we saw was an inability of the bank itself to actually do appropriate interest rate risk management. And of course, the supervisors who are attempting to come in and should be identifying it and acting swiftly to keep it from becoming what in fact it became. So what we see really in that episode alone is this integration really of of supervision, of interest rate risk management more generally. And we see also how the Fed then was compromised in its ability to move ahead as it had wanted to on its inflation fight. And regardless of what you think about, whether the path was, whether they were on the right path, whether, enough was enough, regardless of that view, the Fed had signaled prior to the failure of SVB that it was going to continue to increase the federal funds rate. And what essentially happened because of the event is the Fed had to back off of that. And they did raise the Fed funds rate, but not to the extent which they had signaled earlier. What we are seeing now, of course, is a contraction. Financial conditions have tightened post this set of events. We have seen ramifications on the on the role of community banks and regional banks. So deposits are fleeing these banks. They are going into money market funds. They're going to the largest banks, changing most likely the landscape of what banking looks like in the U.S. So the question is, what does all this really mean in the climate context? And that's, I think, the frame for this discussion. My own view is that the Fed really is conducting monetary policy now in a way in which it's missing out. When you ignore climate-related financial risks, you're actually missing out. You are not acting from a policy perspective in an optimal way. Okay, and we can elaborate on that in these, in this panel today. But essentially, I think that the failures here are, that first of all, we're losing a good tool here, which could be deployed much more effectively than it is. So it's, a failure to appropriately understand transmission actually has effects on financial stability. The failure to include banks as intermediaries, that has a role in terms of how you understand this transition occurring. And of course, sort of taking climate data out of your equation means that you may not be looking at supply shocks, supply bottlenecks, different kinds of supply events appropriately if you're saying we're going to be, we're going to take climate out of the realm here. I think one of the interesting questions for people in this room to think about is this notion of whether you can conduct monetary policy and financial stability policy in kind of a threat agnostic way. Can we? And it's a legitimate question. In other words, if you just imagine threats, but you don't specify where they are coming from, can the central banks still do their jobs? And I think that these sort of the terms I've been playing around with is this notion of being threat agnostic, threat informed, or threat specific. Now, when you talk about climate-related financial risk, that is threat specific. You are naming the risk, you are naming the threat, and you're going to ask yourselves, if you're a policymaker, how do I incorporate that particular threat that I'm naming into my understanding of the conduct of monetary policy and how the economy is working? That would be essentially a threat-specific approach. On the other end of the spectrum is threat agnostic. We won't say the name, we won't say what the threat is. We will imagine something big, something that has a contagion effect perhaps, but we won't name it. And we'll make sure, by the way, that capital requirements and any kind of regulatory responses are somehow sufficient. Can that be done in a threat agnostic, from a threat agnostic perspective? And then I think you have something in between. You've got the threat agnostic. On the one hand, you've got the threat specific on the other, where you name it, and then in between I would call it like threat informed. Okay, threat informed. And I think that's one of the questions really of the day, which is certainly what we're seeing from the Federal Reserve is something that appears to be somewhere in between threat. Well, let's just say it what it is. It's threat agnostic. Okay, there is not a naming of climate-related financial risk. It's certainly not threat specific. And what we would hope for, I think, is that it be threat informed. So that, I think, is just a little bit of how I'm kind of framing my understanding of what needs to get done certainly with the conduct of monetary policy as it's looked at by the Fed. But it's this idea really of a much more integrated approach between supervision, regulation, understanding the effects of climate in a much more sharp way than we've seen.
Wonderful. Thank you very much, Sarah. You know what you said echoes something that was said a few years ago when we had a conversation on a similar topic, where the issue of silos that you mentioned came up and the need to integrate and move beyond silos. I will later want to move a little bit deeper into what is it that the Fed would do differently if it had a threat-specific approach. But before that, James, over to you.
Thanks very much. First of all, let me just say it's a great pleasure to be here with all of you today and with my two distinguished colleagues on the panel. So I thought I'd just start off by talking a little bit about the work that we've done at the Bank of England on climate. And I think really I'd describe this as kind of like a three-stage process that we've gone through. The first stage that we started, probably around about 5-6 years ago now, was microprudential in focus. And I think the aim of that work was to ensure that the financial firms that we supervise and regulate were properly engaged with the impact of climate change on their resilience. The second stage I would call macroprudential, which is we want to take that story on and we want to see if the system as a whole, the financial system as a whole, is resilient to the effects of climate. And at the Bank of England, we have specific responsibilities that were given to us after the financial crisis for macroprudential policy. And the way we did this is we developed a financial system-wide scenario in terms of the impact of climate, and we published that last year. The third stage is the most recent, and it's work we've just really begun, and it's actually the topic of this panel, which is to understand the impact of climate on monetary policy. And I'll focus in my opening remarks on that, since it is the topic of the panel. But I think where I might start here is on mandates, which I think has become very important in the debate. So at the Bank of England, our Monetary Policy Committee has a primary mandate to achieve price stability, which is enshrined in an inflation target. But we also have a secondary objective. So we're a little bit different than the Fed. We don't have a dual objective, but we have a secondary objective to support the economic policies of the government. And of course, one of the economic policies of the UK government right now is to transition the economy to net zero by 2050. So that immediately brings us into focus for us at the Bank of England. So when we got this mandate, we were kind of trying to figure out, so what should we do here? What does this mean for us? But I think actually, when we thought quite hard about this, I think the mandate sometimes can be a little bit of a red herring. And I think there's a lot of debate among central banks about what's my mandate, what should I do? But actually, I think if you sort of strip this back on the macroeconomic side, if you take it as given that climate shocks are going to be bigger and they're going to be more persistent in the future, then I think it becomes macro relevant. And as monetary policymakers, we have a responsibility to treat any macroeconomic shock and to react to it. So I guess that's the first point that I wanted to make. So in terms of, if you take that premise, then I think you start to think, well, okay, so what effect does climate have on the macroeconomy? And obviously you can start with physical risks, the most obvious. And I think here, as monetary policymakers, the sort of classic response to a shock like this, if you have a flood or a drought, is to say, it's a one-off shock, I'm going to look through it, it's for the government to deal with it. But again, if you start to think, well, actually now I'm having a flood every year, or I'm having a drought every year, these shocks are bigger, then I think as monetary policymakers, you need to start thinking about those impacts, as I said before. The second point, which is a little bit UK specific, is in the UK, we're kind of in a fortunate or maybe unfortunate situation, which is that our geographical location means we don't have great weather in the UK, but it does mean that we're not as susceptible to climate shocks directly as many other countries. And there are some estimates out there from S&P that say that in a pretty moderate climate scenario, only around 1% of UK GDP is vulnerable to climate-related risk. Now, of course, for some countries, those estimates are 100% right, and it's much more relevant. But the bit I did want to draw out for the UK is the UK is a very open economy. And so it's very dependent on importing goods from countries that do have climate shocks. And we saw this a couple of years ago when there was a big drought in Europe, no barges able to go down the Rhine, there was shortage of goods, and that does have an effect on the UK. So even though we're not directly hit by these physical impacts as much as other people, we're still hit through that international transmission. And then the third point I wanted to come to was on transition, which is so if we take it as given that many of our governments have said we're going to transition to net zero, that's going to require policies. Those policies probably require raising the price of carbon in a pretty kind of persistent way. Then again, that's going to have a big impact on the economy and also inflation, which is our primary mandate. So again, I think that's a challenge for monetary policy makers and not one that we can ignore. The other point I wanted to bring out in terms of monetary policy was our monetary policy tools. So ultimately, kind of the Bank of England, and any central bank is there to influence the aggregate level of activity in the economy to stabilize inflation. And we do that with a series of tools. But one tool in particular that we've used, we're not using at the moment, but we've used in the past, is we buy corporate bonds. And the reason we do this, like any other central bank who's done asset purchases, we buy these assets to boost economic activity to get inflation back up to target. And obviously that's not a problem we've got at the moment. But when we did this, what we tried to do in purchasing these corporate bonds is we want to target aggregate activity. We don't want to try and do credit allocation. So we basically say, well, let's buy the market. Let's be market neutral, basically. But I think when you think about it, what does market neutral actually mean? Because if the market isn't pricing climate risk, something that you think is market neutral may not actually be market neutral. And so this is something that we've been thinking quite carefully about at the Bank of England, and we published a paper on this a couple of years ago, which is to think about how we would adjust our portfolio of corporate bonds to try and correct for this. If you believe that, if you want to be market neutral, how do you correct? And I can say a little bit more on that later. The final thing I would say on the operations is I think that, and again, this comes back to the point about mandate, in my view, it's very much for governments to set out the path to net zero. It's for them to put in place transition plans. But I think we as central banks can think about what we can do to support that by catalyzing action. So, for example, in terms of the assets we're purchasing, if we can focus on firms who have a good climate track record, and that is very complicated and how you measure that is difficult, but then we can kind of try to catalyze action and incentivize firms. So it's not about direct credit allocation. It's not about directly trying to do things, but it's about making sure, we're consistent with that market neutrality principle, but it's also about setting incentives where we can. But maybe stop that for now.
Wonderful. Thank you, James. And maybe one important point to mention there is that in doing so, you're not just looking backward in your scores that you're applying, but you're also having a forward-looking approach to see where do companies stand in setting targets and in pursuing these targets.
I think that's a really important point.
Yeah, thanks. Tim, over to you.
Yes, thank you very much for inviting me to participate in this event. I was really looking forward to doing it in person, but as Alex mentioned, I had a climate-related shock of my own, encountering some ice in April on the on my driveway in Ottawa, and so I'm glad to be able to participate virtually. But I was really hoping to have some of the better experience of doing it in person. At least this way, my carbon footprint from this event is much lower. I guess a starting point is that there's really there's very widespread agreement among central banks that that climate change and the transition to net zero are both really major economic forces that will be unfolding over the next few decades, and that it's really important for central banks to to do some serious work to incorporate these factors into their into all aspects of their policy, and monetary policy is certainly one of those. And central banks worldwide have really been moving ahead to do that. There's an important distinction here, which I think was touched on by the other participants, but I think is often glossed over, which is one can think about incorporating climate-related risks and other climate considerations in achieving the central bank's traditional mandates for price stability and safeguarding the central bank's balance sheets. But one can also think about going further to use central banking tools to support or promote the transition to net zero. I mean, both of those are possible approaches, but they have different implications for what central banks should actually do and how their success should be measured. So, of course, this also touches on the question of central bank mandates, which James mentioned. Some central banks have fairly narrow mandates, but at the same time, I think even narrow mandates for price stability still give room. I mean, still imply that climate change is an important factor that ought to be taken into account in making policy to achieve price stability. And in other cases, of course, central banks have broader mandates that actually say, at least as a secondary objective, that they should be helping to promote the adjustment to net zero. And of course, even for central banks with narrower mandates, it's important to, I think, for those who set the mandates, to be considering whether the mandates should be broadened. And for those with the broader mandates, it's really a question of, well, to what extent can they actually do very much to achieve those secondary objectives? So one can think about these questions both in terms of the overall stance of monetary policy and its conduct, but also in terms of the market operations, which James already touched upon. So with regard to the overall conduct of monetary policy, as I said, these are major structural changes that should be unfolding over a long time horizon. That's true of both climate change itself, which really implies a series of negative shocks which would affect productivity, floods, wildfires, pandemics, tsunamis, other sorts of events like droughts, and all of those are going to affect the path of potential GDP of most economies in the world, and they're going to be playing out over a longer time horizon. That's also true of the transition to net zero, which means that in effect, because of climate concerns, moving away from the use of what are otherwise economically viable methods of powering economic activities, and that in itself is a major structural change. It implies it affects the path of potential growth, but it also implies big changes in relative prices, in the composition of production and consumption, and in the way things are produced. And so those are major changes that are going to be taking place over decades, and only gradually reflected in the central bank's time horizons for monetary policy. But when you think about the time horizon for monetary policy, the probably more material is the nature of the shocks that are occurring, and both of the other panelists have touched on this. The fact that that you're going to have big relative price and supply shocks taking place. We don't know when they're going to happen and exactly what their nature is going to be, but we know, I think, already from the scientific evidence that there are going to be a whole lot more of them, and that they're going to be a lot more severe than in the past. And there are even the possibilities suggested, as I think Sunil mentioned in his opening remarks, of catastrophic climate events that can be beyond the bounds of what have previously been considered possible. So in that context, of course, it'll be increasingly important. I mean, you can't build those into models. I think as Sarah Blum-Raskin indicated, you can't really predict these things, but you certainly need to be ready to act when they do occur. Now, we have had experience in making monetary policy in the face of somewhat similar shocks. One can think of some examples being the major oil price shocks that occurred. One very sharp and abrupt drop in oil prices in 2015, and then the rise in oil prices that occurred in 2020. too. And that's, those are both major shocks that have implications. But of course, many of the climate-related shocks are likely to be much longer lasting, as well as being very large. Another shock, of course, is the pandemic, which is a major shock that affected both aggregate supply and demand in ways that were not immediately understood by economists. So generally, I think it's fair to say that shocks of this nature are not very well handled by the DSGE models that are kind of the workhorse tool that central banks use to guide monetary policy. Generally, the supply side of those models is pretty rudimentary, and sectoral changes are not well modeled. And the way that those things feed into inflation and the potential implications for inflationary expectations are not well handled. And generally, that implies that there are lessons to be learned, and central banks need to think better about how to modify the models to flesh out the supply side and to understand better how supply and demand shocks are taking place. I think one of the lessons from the pandemic was also that as with climate-related events, it's really for the fiscal authorities to do a lot of the heavy lifting in terms of policy, because they have the tools to do policies that are more sector specific. And so central bank models need to do a better job of incorporating fiscal policies and their implications on the transmission mechanisms of some of the other shocks that they're looking at. And so in that context, there's certainly a lot of lessons to be learned, and those are quite important, going to be increasingly important as we have more and more of these aggregate supply shocks occurring as climate change progresses and as the transition also progresses. And I mean, just to mention one thing about the transition, I think many of the models assume that this will take place very smoothly. I mean, that's often one of these, I mean, at least there are often two scenarios. One is a sort of everything is totally predictable, and the other is that there's some delayed transition where everything is delayed, and then all of a sudden the authorities do the right thing. But I think in reality, the experience of the last several years, I think, should make us more alert to the likelihood that there are going to be, we're probably in for more stop-start policies with regard to climate on the part of many governments, and that in itself is going to imply other sources of macroeconomic shocks. And even the adjustments to policies are also going to have discontinuous elements, and in particular, thinking of the fact that, as the transition to net zero proceeds, there are going to be major relative price changes, as I mentioned, and those are also going to prompt, are going to create incentives for changes in technology. And of course, technology changes, as we know, are in general very disruptive, and that in itself constitutes a source of macroeconomic risk. So all of these things are it's going to be very important to incorporate into central banks' frame of reference, because they're going to have to make policy to achieve their traditional mandates in the face of those events. Now, then the question, as I mentioned, is should central banks go further to use policy actively to support the climate objectives? Now, there's one obvious way which central banks have rejected, which is to have a policy that suppresses economic growth. But then beyond that, which is clearly not on the table, there have been arguments that central banks should try to keep interest rates low to promote green investments that have a longer time horizon. But I think there's general agreement among macroeconomists that central banks can't actually control the long-term, control the real interest rate over a decades-long time horizon. And so what central banks can do through the broader thrust of monetary policy to promote the transition is probably pretty limited. Now, that has really turned attention more to market operations, which James, I think, has also focused on the use of modifying how central banks do asset purchases, assess eligibility of collateral and haircuts, eligibility of counterparties and things like that. I think again, there's very little debate that if there are material risks, central banks have a duty to capture those in their risk management, regardless of what their mandate is. And I mean, generally, to the extent that climate-related risks are material, imply credit liquidity risk, then it's important for central banks to take those on board. And that's and that's certainly something that there's general agreement, and obviously the data are limited, as I think James already mentioned, but certainly we can already start doing the best we can with available data. Beyond that, of course, there's a question of whether central banks should be trying to promote the transition through their market operations, and that's an area where I think there's more difference of view, and partly because I mean, there's really a question about whether central banks have the tools that are sufficiently targeted to be able to do very much, whether they have the information to be able to use those tools effectively, and then the governance that applies to that, which does imply to trying to promote flows of investment towards others, towards particularly particular destinations that are going to be consistent with a plan for transition to net zero. So again, it's more challenging. It's certainly something many central banks are considering, and in the case of the Bank of England and the European Central Bank, have actually been moving ahead with. But certainly more questions about about what central banks can and should be doing. But I guess my point is that central banks should be clear about what they're trying to do, whether they're basically trying to manage their own risks through climate, by taking climate factors on board, which I think is almost unquestionably something they should be looking at, or whether they should actually be trying to go beyond that to promote the green transition. And that's really important to be clear about that in order to define what success looks like, and also particularly in order so they can be accountable for what they do. So that's good for openers. Thanks.
Wonderful. Thank you very much, Tim. And maybe just to add one further distinction, because I think the distinctions that have emerged here in the conversation on what are we talking about, what is the goal, is really important. So we got, as Tim just mentioned, the goal of making sure that climate-related financial risks to the balance sheet of the central bank are properly accounted for. I think that was a key argument, for example, for the European Central Bank to move ahead on this, with back then the Bundesbank President Weidmann saying, this is taxpayer money and we owe it to our taxpayers that risks are properly accounted for. And then we have the goal of ensuring that climate risks, as they relate to other goals, such as employment or inflation, get reflected. And then thirdly, climate change mitigation as a goal in its own right. I think these are kind of the three things we're talking about. With that in mind, as I said, Sarah, I'd be really keen to dig a bit into what the Fed would do differently if it was to look at this topic as a threat-specific issue.
Well, I think what we've all heard, I mean, actually from James's description of what the Bank of England has done, I mean, is really quite, sounds quite appropriate and a quite effective way of starting to understand how you incorporate climate-related financial risk into, say, scenario analysis or stress tests. The U.S. at the Fed is is certainly not doing stress tests on that, are not doing scenario analysis. They have done they've launched a 12-bank pilot, called a pilot, not a scenario analysis, not a stress test, in which they are working closely with 12 banks, 12 large banks, to determine, essentially how climate-related financial risk, gets manifest in the balance sheet and the ramifications for, for supervision and regulation. Are the capital buffers sufficient? Not clear that the so-called shock that has been proposed for those 12 banks is really much of a shock. It doesn't necessarily appear to have been particularly I think it's climate informed, but whether it's climate realistic is, I think, debatable. So not exactly sure that the so-called shock that this pilot is going under is particularly realistic. Now, there is, there's potential here. It's very possible that, this is just a beginning sort of toe in the water on what will get built up to be something perhaps more robust, more realistic. But I think this is where, and James, you might know this better, I think this is kind of where the Bank of England was in like 2018 or 2019, okay? Just to kind of level set where the Fed is right now on that particular approach. Now, when we talk about climate-related financial risk, we're not just talking about stress tests. We're not just necessarily talking about capital. And as Tim pointed out, we're really talking about the appropriateness of the models. Are the models actually reflective of what are turning out to be more persistent, more extreme supply shocks, and is the Fed able to model what is happening appropriately in such a way that it can conduct monetary policy and do the settings appropriately? So the modeling itself, I think, is extremely important. And again, not exactly sure. I don't have. Tim spoke. I think. Quite clearly on some of the inadequacies of supply, the supply equations in the model, that they don't reflect necessarily the right duration, the right adaptation, the essential smoothness of dealing with a shock. At the very least, that's got to be, I think that has to be fixed and looked at. Because without that, you are really getting monetary policy being conducted using models that aren't particularly reflective of the economy.
Thank you. I'm pretty sure that Bill will later also touch on models because it's a topic that has been on his agenda for quite some time, and the need to account for the complexity that we face. James, if we could broaden the perspective even further to get more of the momentum internationally into the conversation. What are you seeing at the NGFS? Where do central banks stand on this, and where do they want to go?
Yeah, thanks. So I'm chairing a work stream at the NGFS on monetary policy, which is relatively new. And the NGFS stands for the Network for Greening the Financial System. So monetary policy is sort of a little bit at the outer bounds of that. But I think although the NGFS started with this work on the kind of supervisory side, we've now realized that monetary policy is obviously a really important factor of what central banks do, and has started to move towards it. And I guess in terms of the international work, I mean, the first point I make is completely obvious. Everyone in this room will know this, but climate change is a global problem, and we need global solutions. And so having a global network like the NGFS, I think, is really useful for that cooperation. So in terms of what we're doing on the monetary policy side, I mean, the first thing to notice when you talk to other central banks is the mandate question always comes up. Right, so what's my mandate? How far can I go? Tim picked up on some of these points in his remarks. But again, as I said in my opening remarks, I think setting the mandate aside, we're all facing common challenges. We're all facing common shocks. We're facing changes in the structure of our economies. We're facing thinking about how the transition path affects things. And I think that is kind of catalyzing action in terms of people wanting to focus on that. And so in the NGFS work on monetary policy, I think the other great strength we've got actually is in my work stream, we've got like 67 central banks. And the great thing about having 67 central banks is everyone's done something different. And I think the thing we're trying to do in that group is basically say, well, to pick on Tim for a second, Canada has a massive natural resources sector, right? So they've probably thought quite hard about modeling natural resources. So the Bank of Canada can bring some of that analysis to the table. At the Bank of England, we've thought about certain aspects. And so the idea, I think, is that each central bank, brings what it's done to the table, and you sort of try and share that knowledge and analysis with others. Now, of course, some central banks haven't done very much yet. They haven't had the capacity to do it. And I think for those central banks, they can kind of learn from the others around the table as well, so that, where there's a kind of willingness to talk about this and to think about this, we kind of bring the work and we kind of share that with others. I think the sort of the one challenge in terms of this international work, and it comes back to a point Sarah was just making, is this kind of modeling question. And, you know, how do you model climate? It's a very, very difficult issue. And I think we've sort of agonized a little bit about this because, you know, in my view, as I said at the beginning, if you can say something's macro relevant, then it's relevant for monetary policy. But in order to demonstrate it's macro relevant, you need a model, you need some estimates. And, you know, as Sarah said, you know, not all central bank models are kind of suitable for this sort of analysis. So I think what we've been trying to do is kind of do three things, really. One is to say, and I think Tim made this point in his opening remarks, climate shocks can be like other shocks that we've analyzed before. And so, you know, as economists, we can think about them, we can think about the reactions, we can do that. The second thing we can do is we can use the models we have and we can try and put climate shocks in. And that's not perfect, but it is at least a way of getting going on the analysis. Because I think sometimes, you know, you have this kind of, you know, paralysis around the modeling. Oh, you know, I need a beautiful model with everything in it and I can't get going. So that's a way of getting going. But I think the third thing is I think it is important to push the frontier forwards. Because, you know, we all want tractable models, but equally the models have to be realistic. And so we want to try and use and harness some of that work going on around central banks around the world to try and develop better models as well. So that's the sort of approach I think we're trying to take.
Very interesting. Thank you. Before we open up, I wanted to bring in one further dimension and ask Tim to comment on that. Because when we talk about risk management within central banks, we're in a very technical way, also talking about the use of external ratings. A lot of what central banks do in terms of risk management is based on the ratings they get from rating agencies. It's usually an investment grade cutoff that is being used. And interestingly, it were the central banks after the last financial crisis in 2008 that came together in the Financial Stability Board and said, actually, we should reduce this mechanistic reliance on external ratings. And I think it's a technical one, but it's a core one to the topic of how do central banks account for risks and how can climate risk be factored into that. And the Bank of Canada, also while Tim was still there, has, I think, been a very vocal voice on reducing that reliance. So Tim, if you could share a bit of insights from that discussion and how the Bank of Canada dealt with it.
Yeah, thanks, Alex. Yeah, that is something that probably was pushed further. Well, particularly in the wake of the global financial crisis under the leadership of Mark Carney, who was then governor, the Bank of Canada developed its own in-house framework for credit risk assessment, and it's got a sort of an internal governance structure and a whole analytical framework that it applies, and it comes out with its own credit ratings, which are applied to to issues including collateral acceptance, and also the advice it gives to the government of Canada on foreign exchange reserve risk management, and so that framework has been developed, and there's certainly work going on currently to bring climate considerations more fully into those internal assessments. Of course, other central banks, I mean, certainly there was a general agreement by the FSB to reduce reliance on external credit rating agencies, but that's been applied to varying degrees in different central banks, and I mean, to some extent, it's I think in many cases not so much in developing an internal framework as being prepared to make exceptions in cases where the external ratings are flawed in some ways. And for central banks that rely on external credit ratings, of course, there's the other approach, which is trying to get the external rating agencies to take climate issues more fully on board in their risk assessments, and that's one of the things that the European Central Bank has started to do, basically to work with the credit rating agencies to try to broaden their focus and bring climate issues more fully into their focus. Of course, for smaller countries, there's less scope to put pressure on what the rating agencies do, but certainly those are both tracks that could be pursued.
Very helpful. Thank you, Tim. Kyle, do we have a mic coming up? So, who would like to kick us off? We got a question over there.
Oh, thank you. So my name is Remi. I'm the director of the institute. The 2008 crisis started with overvalued housing assets in the US. And we have the same problem where we have coastal housing assets that may be overvalued. Maybe we're investing too much in cities like Miami and other coastal cities. And maybe we're investing too much in cities in the US Southwest where it's going to be really hot in the next 50 years. The fastest growing city in the US is Phoenix, Arizona, which is also going to be the hottest city in 50 years. So should the central banks do more about housing or just focus on productive sectors? My next question is like, what about central banks in developing economies? Are going to be different from central banks in developed economies? And finally, there's some studies showing that economies like Canada may benefit from climate change because they're going to have a lot of valuable land when we're going to have less land in the rest of the world. Whereas other countries like Italy is going to, they're going to suffer from climate change. So what does that mean in terms of like cooperation and coordination? Like maybe some countries will, because they benefit, they will adopt different policies and countries that may lose. So what does that mean for all of that? Thank you.
Thank you. You actually formulated them in a way where it's very clear who can answer, right? Sarah, if you could address the coastal property risk questions, and then James, if you could also from your experience from the NGFS talk about developing countries, and then Tim, the upside for Canada for climate change. Yeah.
So I think the example of the housing sector, I mean, that is just exactly spot on, because it actually goes to the question of, how can you look at a climate-related shock without understanding its effect on specific sectors? And the housing sector is, of course, a very vulnerable sector, given where it may, where housing may be located. And of course, it's not just simply the damage that will come to housing in various areas that will get hit, but of course the migration that comes from from areas that are continuously hit, the effects on jobs, the effects actually on how on adaptation, kind of where the geographies emerge as being population centers. So there are these actual macro questions that and effects that come from looking simply at one sector. Okay, and my contention is that it's really you have to look at many sectors here to actually understand the transmission of how a particular risk is going to get manifest. Housing, of course, is one that is accessible to all of us, and it's one that was completely a focus of the global financial crisis. And how to respond to the global financial crisis needed a complete understanding of the housing sector, of what was happening with foreclosures, how many people, many households actually couldn't actually move to get new jobs because they couldn't sell their homes. So I mean, the interactions really between the macro variables of employment and price stability are manifest when you start looking at sectors. So I applaud the question, and I think it's a very accessible question for people who question whether or not climate-related financial risk needs to be understood in a specific way.
I might just add something to
Yep.
what Sarah was just saying on the first point, then I can come to the second point. I mean, I think your question kind of is almost exactly why we started this kind of microprudential focus at the Bank of England, because we did a survey kind of 6-7 years ago, basically of financial institutions to say, how are you thinking about climate change? And when a lot of them filled in that survey, they basically said, oh, it's an ESG issue. And only 10% of them, I think, that we surveyed basically said, we are thinking about this as part of our strategy at board level. And we were pretty shocked by that, because we were like, well, you're lending to companies who are affected by climate change. Your question on housing comes in here as well. So I think a lot of the part of that microprudential work we did was to try and catalyze some thinking on that. And actually, I think through that work and through that supervisory engagement with the banks, we've been able to get them to sort of start thinking about this, to better understand the kind of climate impacts of their portfolio. So I think that's something that central banks and supervisors can do. On the developing economies point, I mean, one of the great things about my group is there's a really good spread of developing economies in the group, big geographic spread as well. But the one thing that seems to be in common is a lot of these economies are really affected by the physical effects of climate change and affected in quite a big way. And so they're very keen to start thinking through these issues. They're very keen, they perhaps thought about, if I have a one-off shock in this area, how would I deal with it? But this kind of idea that it's a repeated shock, it's a large proportion of your GDP, means it becomes kind of really macro-critical for them to understand it. And so one of the things we're trying to do in my NGFS group is to think about this kind of, okay, so if I have a physical shock on my economy, what are the variables that's going to affect? And in addition, actually, to get a little bit more granular than that, because there are a number of shocks we could have: hurricanes, floods, droughts, fires, and they might affect the economy differently. So what we're trying to do is sort of develop a bit of a taxonomy of a kind of like, what's the stylized path of this shock through your economy, and how do you understand it? So I think that's definitely something that the developing economies have engaged a lot on, and I think they've also engaged on this question of market operations as well. Thanks.
Thank you. Tim?
Yeah, certainly there have been some estimates that for Canada, climate change would have some positive effects, but I think the consensus is that the net effects are likely to be negative. And I mean, certainly when you think about the positive effects, they'd be things like a longer growing season and longer season for water transport, for example, in the St. Lawrence Seaway. But on the other hand, you've got more extreme weather events, flooding, wildfires. I mean, we've already seen that. Probably more frequent pandemics, loss of biodiversity, and also the effect on our export markets. The fact that if it's negative for the rest of the world, that has a negative effect on Canadian exports. So I think most people in Canada are not taking comfort in the fact, the sort of headline number. Well, Canada's a cold country; it should be getting warmer. I think that's. I mean, the negative aspects of climate are more likely to outweigh the positive. I mean, maybe the other thing I'd say though is that because Canada is a large fossil fuel producer, then it is going to have a major adjustment to the transition to net zero, and that's something that Canadian policymakers certainly need to be clearly focused on. There's a bit of a positive to the extent that Canada may also be able to produce metals that are used in some of the green technologies, but at this point, fair to say that the transition is something that's going to have some adverse effects that need to be managed effectively.
Thank you, Tim. We might take a few. We got one over here, and then one at the same time.
Hi, my name is Clara Vondrich. I'm with Public Citizen. Thank you so much for a wonderful presentation. Just on the Canadian environmental front, I just want us to not forget the heat dome of 2021 that claimed over 600 lives with temperatures above 120 degrees Fahrenheit. So I'm not so sure that Canada will be spared. And not to mention, it's not an island, it's connected to the rest of the world. And I speak as a partial Canadian because my father has a place in Nova Scotia, and we've also seen a lot of extreme weather there on the opposite side of the country. Sarah, you mentioned this flight from the smaller credit unions and other banks in the wake of the SVB crisis. And I've been working on the divestment movement for a long time, fossil fuel divestment and clean energy reinvestment. And one of the biggest messages we were trying to convey was the need to move out of the consolidated big bank monopolies, which tend to focus on fossil fuel investments, to the smaller banks that have more flexibility to reject a so-called full diversification kind of approach. And I just wonder whether you see this trend as serious, whether we're going to see like a deep consolidation at the big banks, and Also, just want to note that today the Sierra Club and a bunch of organizations released the Banking on Climate Chaos report, which noted that the biggest banks globally are still investing billions of dollars in fossil fuels despite their net zero commitments. And this year, RBC, the Royal Bank of Canada, has the honor of being the leading fossil fuel investor for the first time, overtaking JP Morgan Chase.
Thank you. Let's take a second question from the same table.
Thank you. Thanks so much for this great discussion. My name is Lilith Fellows-Granda. I'm at the Center for American Progress. I think all of the panelists noted the difficulties with modeling climate-related risks, but also that exercises like scenario analysis are important steps in the right direction. So my question may be more geared towards Sarah and James, but I'd be curious in what you kind of expect or what you hope to be, the key takeaways, the most valuable takeaways from the pilot scenario analysis that the Fed has launched for the largest banks, and how that kind of, based off that takeaway, what you hope to kind of see the next steps to be, whether that's, extending that out to more banks or a more macro-prudential focus in future exercises or something else. But
Thank you, Lilith.
First of all, to the question on deposit flight, hard to know actually how sustained it's going to be. One metric that I think is telling is that the facilities that the Fed set up in the wake of SVB are being very heavily used, okay? So this sort of structural issue regarding, uninsured deposits has hit the sort of American psyche in such a way that there has been huge reaction and demand to these events, and we see that demand showing up in the facilities, which are at unprecedented levels. I think they're sort of 4 times higher than what they had looked like before. So, and of course, one facility was set up just in wake of the crisis. So I think one way to measure, sort of to gauge your question, is to kind of understand and see the continued use of those facilities, which in my mind show, they are indicators of stress. They are indicators of stress. And, that, some people will say, oh, it's, actually, it's good. It's both good that we have these facilities because they did seem to, contain the contagion. On the other hand, you can see essentially that they continue to be used. So there is a structural issue that I think is going to have to get addressed. My own sense is that this migration has slowed down, but that it is still occurring. So in the public mind, the public view is that these banks are not as safe as the largest ones. And again, large inflows at money market funds and large inflows at the largest banks. To the question of what can be learned from the pilot, I mean, it is a good step. It's a first step. I think that the Bank of England has actually shown us a bit of a roadmap that can be taken. So once you see some of the early, you do some of the early kinds of tests, you start to refine your modeling, your assumptions, your scenario. It is a very, my own reaction, it's pretty slow. I mean, it's a pretty slow process and not necessarily a realistic one, and query as to whether there will be anything generalizable that comes out of this exercise. Glad it was taken. I also think it points to the fact that that when you think about financial stability in the climate context, it should not be all about developing the a perfect scenario analysis or stress test. There have to be kind of other considerations and other tools at the table.
James, would you like to come in on scenarios?
Maybe briefly, yeah. I mean, I think the sort of the good news on scenarios is work is continuing. So one of my colleagues at the Bank of England, Sarah Breeden, used to chair the NGFS scenarios workstream, and those initial scenarios that you mentioned, I think, have been used as a basis for a number of central banks and also private sector organisations. You know, we use them in our own kind of scenario exercise. And the really good news here is the ECB have taken over this work. Paul, who you'll hear from later, is involved in this. And one of the key things they're thinking about, I think, is when we did that first set of scenarios, obviously because it's climate, we wanted to use quite a long horizon. And that makes sense, it makes economic sense. But I think when you show something like that to the banks, they kind of struggle with it a bit because they're used to kind of stress testing over shorter scenarios. The kind of static balance sheet assumption over such a long horizon becomes very problematic. And so one of the things the ECB, I think, is looking to do now is to try and shorten the horizon of some of these scenarios and to try and look at that, how that affects things. The other thing I would say is that in terms of our experience with scenarios, you know, we used a specific model for the scenarios that we did in the bank and in NGFS as well. And when we started to put those scenarios through other models, we did start to get some different results. And I think that's something that really needs to be explored, actually, because, you know, you need to sort of take those conclusions. But the final thing I would say is, I mean, you mentioned kind of valuable takeaways. And I think for us, one of the best takeaways from this exercise was to basically get the financial institutions themselves thinking about this. Because essentially, I think what it kicked off is it kicked off a thought process. It kicked off risk management on their side, but it also kicked off a really big data collection exercise as well, where you just don't have data, right? And so if you know you're going to have to do scenarios, you know you're going to need the data, you're going to start doing those things for yourself, basically. So I think that was another kind of important takeaway from that exercise.
Just a quick one on time horizons. I think one thing to recognize is that the threat to the financial system materializes when people get concerned, not when it materializes in the real economy. And I'm sometimes like reminding myself of a report by the Swiss regulator after the 2008 financial crisis about the subprime papers that were held by large Swiss banks, where it said, the risk managers were assuming that if these papers turn bad, they could get rid of them on time. And then I think there was this beautiful sentence, this assumption turned out to be too optimistic, right? and I think we have to remind ourselves that if people say now, well, if things go bad, we can just sell, not everybody can sell at the same time, right? So the time horizon issue, I think, is less of an issue than we sometimes believe. Further questions or comments? We got one at the table down here and one at the table in the back.
Thank you again for the informative and inspiring discussion. I would love to hear your personal thoughts on banks' capital adequacy requirement, which is a threat-agnostic traditional central bank tool that can be used to address the increasing shock induced by climate. So related to climate, there are two main approaches being proposed. One is because the climate shock is systematic to all banks, so all banks should increase their capital requirement. The other thought is because some of the banks have less exposed to climate risk in their portfolio, so the banks with higher exposed to oil, gas, and carbon-intensive, more risk industries should have higher capital requirements. At the same time, the banks have better climate-aligned portfolios should have lower capital requirement. This also creates financial incentives for banks to pursue more climate-related activities. What do you think? Thank you.
Take one more from over there.
So spring meetings are going on, and a lot of small central banks are asking that given all the technical limitations that have come up this morning, I think, for example, Tim mentioned about modeling constraints, just as an example. These were countries, these were central banks actually who were moving towards formal inflation targeting and price stability. And they are asking, in light of the experience that we are just discussing this morning, does it mean that we should stall our effort to go towards a formal framework of inflation targeting? And I'm wondering whether, if they were to come here and ask, what would we tell them? Because what I'm hearing is a lot of work, a lot of exchange, but at the same time, a lot of incapacity to really model these with precision. And personally, I fear that the entire thrust and the movement that we had got towards central banks moving more formally towards price stability, for the smaller country central banks, this may really mean that there is some stalling. That's the sense I'm beginning to get. So I'm just asking, what, if you can, what would we tell them? Or what should we tell them? We can't possibly say just wait one day, we will come up with something, a modified DSG model or whatever it is. That'll be too late for these economies and they will struggle. Thank you.
Thank you. So the topic of capital requirements will be a focus on the next panel, but I would nonetheless love to get you in on this, Sarah, if you would be comfortable sharing some thoughts on that. And Tim, if you could pick up the second question on inflation targeting and alternatives. Sarah.
So I think your question is absolutely, it's just pitch perfect for what the tension is right now regarding the extent to which we're going to see a threat agnostic perspective, which would require a certain amount of capital, or whether we're going to move into risk-based weighting. You're essentially, if you're looking at pieces of the portfolio, that leans into sort of a risk-based weighting approach. We know risk-based weights have had their challenges, okay? At the same time, I think your point is well taken that different portfolios are going to have different kinds of experiences based on their various concentrations. So this, I think, is yet to be seen. But I would offer sort of one observation, which is that if we do see a capital-based examination being conducted in a threat agnostic way, it strikes me that you would need a lot of capital in order to actually deal with the kinds of risks that we've been talking about today. And my sense, pragmatically, is that the amount of capital that would be required is so hard for banks and their supervisors and central banks to get their heads around that there could very well be an instinct to kind of move into sector-specific concentrations and a risk-based approach.
Thank you, Sarah. Tim.
Yeah, so I guess maybe a starting point would be that to do inflation targeting, you don't have to have the perfect model. I mean, inflation targeting is about being clear about what you're trying to achieve, and being transparent about what you're taking into account in trying to achieve it, and what your actions are in that direction, and then being accountable for the results. So that doesn't really require that you have all the models that you might possibly want to have. It just requires that you do the best you can with the available models and data. And obviously, we all know that despite all the improvements in central bank and in macroeconomic modeling over the last decades, I mean, there are still significant limitations to the models that central banks use. But in that context, what's important is to apply critical thinking to the models, to test out your assumptions. I mean, to make sure that you understand which assumptions are driving which result, and to be clear about what would happen if those assumptions turned out not to be correct. And that I think is always important for central banks in making monetary policy, but I think it's all the more important when they're facing shocks of a different nature. And certainly the experience of the pandemic is a pretty clear illustration of how important it is to challenge the assumptions and to recognize that some forces are going on that are not the usual ones.
Thank you, Tim. So these 75 minutes have passed pretty quickly. I would have had a long list of further questions, but I did want to surface one further aspect and end on that with a question to you, Sarah. So we've spoken about the different elements in the mandates that provide the rationale for acting. And we've spoken about the different types of responses, on the one hand, in terms of modeling and how that informs the overall monetary policy stance, and on the other, about monetary policy operations. And on that latter point, we mentioned the asset purchases conducted by central banks. We mentioned the refinancing operations that they offer and the collateral frameworks that are at the center of these operations. And we didn't yet dig a little bit into one thing that Tim highlighted, which is the whole question of targeting monetary policy operations. And I wonder to what extent can we look at other targeted operations and learn from that, be that you mentioned geographical concentrations of risk. I remember the Bank of Japan, in response to the tsunami, actually offered refinancing for loans to firms in areas of Japan that were particularly affected by tsunamis. I remember in the US certain lending facilities that were targeted at particular sectors. To what extent are there analogies that could be helpful in targeting with climate change in mind?
Well, I think your question really shows the opportunities here. So there are, and we have seen, the use of emergency lending facilities set up by the Fed in response to the pandemic, in response to the financial crisis, in response to this last banking crisis. The Fed has discretion. As soon as you're in the realm of systemic, as soon as something has been designated systemic, you really have quite a bit of leeway to design programs that can be quite targeted. And, and you've asked the question of, well, what would that look like in the context of climate? Now, of course, the way these programs have happened in the US is they've come after the fact. They've come as a response, okay? The question, so the really challenging question is, how do we imagine the use of these facilities in a proactive way, in a way that comes before the cataclysm, right? And that, I think, is quite challenging, quite challenging. I think, the opportunities, though, to actually start to play with some conditionality around these emergency lending facilities in similar ways, that were discussed here regarding how, certainly how the Bank of England has thought about some of its open market operations and this idea of neutrality. More can be done. More can be done for sure.
Thank you, Sarah. Actually, more can be done is a good way to end this panel. Thank you all for the very nice and interesting discussion.